Imagine earning a steady 8 to 10% yield from private companies you've never heard of, without being a billionaire or locking up money for a decade. That future just got very real when Vanguard, Blackstone, and Wellington unveiled a retail-friendly private credit fund on April 15th of 2025, calling it the next step in democratizing alternatives for everyday investors. For retirees hunting income, this may sound like the holy grail, so let's unpack what private equity and more specifically private credit can and cannot do for your retirement paycheck. First, a quick primer. Traditional private equity buys controlling stakes in businesses, fixes them up, and hopes to sell for a large capital gain years later. Private credit, by contrast, simply lends to those same companies, collecting interest every month. Because the loans are negotiated privately, there's no daily price swings flashing across CNBC, which can be great for nerves, but also mask real risks. More on that later. For decades, this corner of finance was an exclusive club. Minimum entry often started at $5 million, and you had to agree to tie up your money for 10 years or more. Even large 401k plans were shut out until the U.S. Department of Labor issued a 2020 letter saying a measured allocation to private equity could live inside target date funds, provided fiduciaries did their homework. Still, practically nobody in the middle class could write those checks until regulators warmed up and fund managers or fund engineers got creative. Enter the interval fund. Think of it as a mutual fund with a revolving door that opens only once a quarter. In 2020, assets in the U.S. interval funds were just $18.6 billion. By January 2025, they had ballooned to $93.4 billion. That's a five-fold surge driven largely by private credit strategies. Why the stampede? Well, investors, they want yield, and private loans are dishing out double-digit coupons. According to FS Investments, the average private credit portfolio today yields 10.15%. That's a juicy 226 basis point premium over comparable syndicated offers. Publicly traded business development companies, or BDCs for short, tell a similar story. RA's Capital, the largest BDC on the NASDAQ, sports an 8.6% dividend yield paid quarterly. Those numbers tower over the 6 to 7% you might collect on a high-yield bond ETF. So what changed? First, supply. Banks pulled back on middle market lending after Dodd-Frank, leaving a multi-trillion-dollar funding gap that private lenders raced to fill. Second, demand. Retirees are starved for income after years of near-zero rates, and they're willing to trade some liquidity for yield. Finally, validation. When Vanguard, arguably the poster child for low-cost indexing, partners with Blackstone and Wellington to offer an all-markets fund that mixes public and private assets, the signal couldn't have been clearer. Private credit has gone mainstream. But before you back up the truck, let's talk about risk. Interval funds repurchase only about 5 to 10% of shares every quarter. If more investors want out, the manager can gate redemptions, meaning your exit is delayed. Valuations are also less transparent. The price you see is based on a manager's models, not real-time market quotes. And fees. Expect 1 to 2% for management plus a 10 to 20% cut of profits if certain benchmarks, aka hurdle rate, is met. If you've ever heard of the term 2 and 20 in investing terms, this is what they're talking about. In private equity, 2 and 20 refers to a common fee structure where general partners, or GPs, receive a 2% annual management fee on total assets under management, and a 20% performance fee, also known as carried interest, on profits generated above a certain hurdle rate. The hurdle rate is a benchmark return that the fund must achieve before the GP or general partner is entitled to that carried interest. It's a crucial element in that 2 and 20 structure, as it ensures that investors are rewarded for their capital before the fund managers receive their performance fee. This structure incentivizes GPs to maximize returns for investors, those are limited partners or LPs, while covering the fund's operating costs. You also need to pay attention to the macro risk. The Boston Fed warns that the meteoric rise of non-bank lenders could shift systemic risk outside the traditional banking sector. Meanwhile, Larry Fink's 2025 annual letter to BlackRock shareholders cheers the democratization of investing, but also cautions that access alone doesn't guarantee outcomes. Due diligence matters more than ever. So where does private credit fit inside a retiree's portfolio? Well, a bucket approach works well. Keep 50 to 60% in liquid, low-cost public market ETFs for day-to-day spending and emergencies. Dedicate perhaps 10 to 15% of the income sleeve, that portion funding years 2 through 7 of retirement, to interval funds. Conservative investors might cap exposure to 5%. But remember, should the Fed cut rates aggressively, those coupons will shrink and defaults tend to rise in recessions. And if you're thinking, great, so where exactly do I hold these private market plays without triggering a tax hit? The answer may be a self-directed IRA. It's a specialized retirement wrapper that opens the door to both private equity funds and direct lending deals. Picture this, you roll an old 401k into a self-directed IRA, or an SDIRA for short, and suddenly the menu of investments expands from vanilla mutual funds to private credit funds, direct loans, and even equity stakes in startups. A self-directed IRA is simply a traditional or a Roth wrapper that IRS lets you steer into almost any asset the tax code doesn't explicitly forbid, including private equity and private credit. You still enjoy tax-deferred or tax-free growth inside the account, just like a regular IRA. Setting one up is easier than it sounds. First, you need to choose a custodian that specializes in alternatives, because the big brokerage houses rarely custody private placements. Firms like Forge Trust or Directed IRA open self-directed IRAs online. They hold your subscription documents and help maintain for tax advantage status. After the account is live, you can fund it with a new annual contribution that's $7,000 in 2025, plus a $1,000 catch-up if you're over 50, or by transferring an existing IRA or rolling over a workplace plan, which is how most retirees move meaningful capital into these types of accounts. Then it's a 3-step process. Wire cash to the private credit fund or direct lending deal that you've vetted. Receive interest or dividends back into the IRA, and watch those earnings compound tax-sheltered until you take out distributions. But freedom comes with guardrails. The IRS bans self-dealing, so you can't lend money from your IRA to yourself, your spouse, or other disqualified relatives, nor can you pledge the account as collateral for a personal loan. If you break the rule, the entire account could be deemed distributed and taxed overnight. If the deal uses leverage or produces active business income, your IRA may also owe unrelated business income tax, or UBIT, at trust tax rates on amounts over $1,000. Finally, private investments are illiquid and paperwork heavy. You're responsible for the due diligence and for providing fair market valuations to the custodian each year. Bottom line, a self-directed IRA lets you tuck high-yield private credit payouts or long-horizon private equity bets inside a familiar retirement product. But you'll need the right custodian, tight compliance, and a clear view of tax quirks before signing those documents. Here's a quick due diligence checklist. First, manager's track record. How did they navigate 2008 and 2020? Second is the structure. Is it an interval fund, a tender offer fund, or a publicly traded BDC? Third is the fee structure. Make sure you add the management fees, incentive fees, plus any other additional expenses to manage that fund. Fourth, liquidity. What percentage of shares can you redeem and how often? Finally, portfolio disclosure. Do they publish industry breakdowns, loan-to-value ratios, and default rates? If you're intrigued, start small, maybe $25,000 if you're rolling over an IRA, and set dividends to reinvest until you actually need the cash. Check whether your brokerage already lists interval funds. Many custodians already do. Next, ask your advisor if Vanguard's new multi-asset fund will be available on your platform when it clears in final SEC review later this year. And bookmark resources like KKR's Private Credit 2025 Outlook for ongoing guidance. Private credit offers eye-popping yields and reduced drama compared with public bonds, and innovative wrappers are finally bringing these benefits to Main Street. Yet liquidity gates, confusing pricing, and higher fees mean it's not a set it and forget it substitute for treasuries. If you got value out of this video, I think you'll like one of these two videos to watch next. Thanks for watching. Make sure you hit like, subscribe, drop a comment down below. Let me know what your thoughts are on all of this. Until next time, thanks again for watching. Have a great day.